Oh, Mario, what's up, you guys? It's Royce Jacob. Welcome back to the channel. In this video, I want to share with you guys a few different and somewhat unique data points and charts that lead me to believe that a period of extended relief is on the horizon for the stock market. Even in the case that we see another splash of red as we close out this crazy month of May, I do think that the other side of this 3-day weekend will be green, and that the new month of June will be a lot less scary and a lot more green than the month of May. All right, you guys, so this one's going to be pretty simple. The majority of the macro arguments that I want to make, I've actually made and explained in depth in my newsletter over the past couple of days. So I'll read over some highlights from these bad boys, go over a few key points, not only from myself, but other analysts that I respect very much in the space. And again, some pretty unique charts. We'll take a look at this one. We'll take a look at the good old fear and greed and this bull bear spread, which I've never shared on the channel, but I'm excited to do so today. All right, so we will get to reading, but before we do, you guys, I want to let you guys know that you only have a few days left to take advantage of the 7-day free trial for the newsletter along with my complete portfolio. Okay, so you want my daily newsletters. I put 4 to 5 hours every single morning into writing these bad boys. There's 3 every day. There's a trade alert. There is the ones we're going to be reading, which is the primary newsletter. And then the third and final newsletter is a bunch of charts. This is just an example of this morning. Scroll through that real quick. Just to give you guys price targets and real-time analysis on some of the positions and some of the names that are most critical and most crucial and most close to the Waves fam and the portfolio. Okay, so again, 7-day free trial. Give it a shot. If you don't like it, just bail out. But I trust you will be sticking around. I'll let you be the judge of that, though. First link in the description box down below if you want to give it a shot. But hey, if not, no worries at all. I appreciate you watching right now. Let's get to reading. Okay, so go up to the very top. Not right there, but we will go right there. Okay, so buy the dip and sell the rip has been a hyper-effective trading strategy over the past few months, which thankfully we've played quite well. But I believe that this time around, it may be time to hold on to that rip, and rip obviously means rally. So the past few days, we have seen some relief in the market, some nice bounces. And again, I don't think this will just be a bounce with another move down. There we go. But I do think that this could be the beginning of, once again, a prolonged period of relief. I'm not talking long term. I'm not talking the bull market's back. But I do think that, once again, the following weeks, maybe even going into the coming month or two, could see some relief following what has felt like pretty much never-ending downside for some of our favorite names and just the stock market overall. All right, so to those who have bought these dips and believe that the markets have finally bottomed out, have had to face the painful reality that more downside is ahead. I'm confident that they'll be in for a pleasant surprise. The old Wall Street saying is sell in May and go away. But I think that buy in May and stay, I will definitely be putting that in the title of this video, is a far more appropriate quote to abide by in this chaotic 2022 market. Let's keep those money flowers blooming through this summer. Okay, so please let me know, you guys. Did you buy the dip? Did you buy a lot of those lows we saw last Thursday? And yeah, just let me know what you're buying in this market environment. What are you buying for the long term, even if you're still a little bearish on the short term? What are you buying right now for the long term? Let me know down below. Okay, so one of my favorite market analysts, Mr. Mike Santoli, released a list this morning of his primary reasons for a short-term rally, and I wanted to share with you guys. I'll reiterate mine next. On the note of that May saying, you can see in point number 4 that positive historical patterns follow Memorial Day. That's this weekend. And as you already know, many of the upside price targets I have set for our positions falls into mid-June. Okay, so number 4, we'll just kick it off with that, and then we'll read the others. Positive historical patterns after May options expiration and ahead of Memorial Day. Okay, 1, depressed investor sentiment and defensive fund manager positioning. 2, the S&P 500 flirted with a 20% drop, as it has several times in history before stabilizing. 3, 7 straight weeks down. 7 straight down weeks heading into this one was historically extreme. That's kind of what we'll actually look at in this chart below. Okay, so remember that. 4, again, Memorial Day, positive momentum. 5, possible traction for the S&P 500 near cluster of downside targets from 38 to 3,900. 6, ebbing treasury yields provide stock bond diversification and lifting some pressure from valuations. And lastly, month-end rebalancing into equities after they'd lagged bonds badly in May. Okay, on top of all the arguments made and to come, the S&P 500 is experiencing its 4th worst year ever when it comes to its first 99 days. And as you can see by the other top 6 down below, which we'll take a look at right now, it's more likely than not that the year will close green. So let's take a look at this. Again, you guys, it's crazy that 2022 is the 4th worst year when it comes to the return on the first 99 trading days of that given year in the S&P 500's recorded history dating back to 1928. Okay, so almost a century, and we got number 4. It's pretty good, all right? It's not, I mean, you're not getting the middle, but that's honorable mention for sure. And as you can see here, the top 6 from the end of those 99 days. So day 100 to the end of the year. So the 100th day of 2022 going into the beginning of 2023, you can see that the return has been green. Okay, worst case scenario was 1.2% green, but hey, it's still green. And best case scenario, which let's just average the returns from number 3 and number 5, because that kind of makes kind of sense enough to me to make it worthy to talk about. So 27 and 9, so 27 plus 9 divided by 2, 36 divided by 2, that should be an 18% return if my second grade math is correct there. Okay, so hopefully from day 100 to the end of the year, the SPY can return 18% from the lows it saw. And again, you guys, this macroeconomic environment is unforgiving. I want to reiterate that I don't think the overall macro bull market is back yet, but I do think that the far majority of the market is oversold right now. There's been more than enough scary events that have been happening. Again, that's where the fear and greed index does come into play, who we'll be referencing here as well. But the markets are just so fearful that it's very unlikely to me that there could be anything that initiates a greater sense of fear when it comes to macro catalysts. Okay, unless we get into a nuclear war or something, then maybe. But hey, other than that, there's earnings are over. I mean, the Fed isn't meeting for a while now, and again, unless the Fed comes out with a major curveball, which is pretty unlikely, I think the markets have priced in pretty much everything. Okay, so every environment is different, and this outcome obviously isn't guaranteed. But as a trader, you need to use all of the statistics available to you and do your best to skew the odds in your favor. Right now, the far majority of metrics favor the bulls when it comes to the short term. Let's wrap this up by reiterating a couple of my primary points. Okay, so trustee, a good old fear and greed index, is still sitting in the extreme fear zone at a 17. Due to you can see it right here, 17. 25 is the line of fear, 50 neutral. Boom, boom, boom. You guys can see that for yourself. Due to the fact that we've been spending an excessive amount of time in this extremely fearful zone, I expect that we'll see a 25 plus reading in the very near future. I still believe that reclaiming levels of just fear is one of the reversions to the mean that we need to see prior to any meaningful downside. Okay, so I've referenced this a lot. Keep referencing it as long as necessary. But as you can see here, this is the fear and greed. This is a chart of the fear and greed index over the past year. I wish it went back further for a little more just data points, but this will do. Because anyway, the point is, it's very rare that we spend a prolonged period of time in extreme fear without seeing a bounce to just standard levels of fear. Right now, we close the day at an 18. The markets did see some relief today. Close the day at an 18. But I do still think we need to see 25, see 25, at least touch 25 and hover there for a day or two prior to heading back down and getting more fearful again. Okay, but again, we've spent so long in extreme fear. I do think, again, the harder you fall, the harder you bounce. And I do think we will stabilize and once again revert to that mean around 25, maybe 30. Again, you guys, the macroeconomic outlook overall is still bleak. It is reasonable to be bearish, but it's not. It's reasonable to be fearful. It is not reasonable, and it is actually irrational, objectively, to be extremely fearful. Okay, fear makes sense. Fear can be rationalized. Extreme fear can usually not be rationalized, especially for a prolonged period of time. Okay, like nothing is super crazy right now. Again, environment bad, nothing super crazy. Okay, so these arguments, along with the bull bear spread chart that I shared with you yesterday, which we'll take a look at right after this, along with the fact that I believe the far majority of potential macro headwinds have been priced in, all lead me to believe that more upside is in the cards. And then yesterday's newsletter, not going to go over the whole thing, did talk about Mr. Powell a little bit, but I just want to read this part for you guys. Okay, this is the bull bear spread, which, as its name implies, would be a better word, tracks bullish versus bearish sentiment. As you can see, every time we've seen these two cross paths in the past, they didn't stay in each other's presence for very long. We're also currently facing some solid support, as seen by the dark blue line on the bottom. Okay, so as you guys can see here, bulls is this light blue, the bears are the orange, and then this dark blue is that bull bear spread, just kind of averaged out. Okay, so you can see here in the past, I like how this one dates all the way back to 2000. You can see that it's pretty rare for the bears and the bulls to cross paths, and it has had. This is just like back in 08, that was just a shit show, honestly. So I don't think it's gonna get that bad. Just watch the last video talking about how I don't think this correction is even comparable to that of 2000 and 2008, just for very, very obvious fundamental, like very, very evident reasons. They're different. Just go watch it if you haven't yet. But again, I don't think we'll go that far. Every other time than that, even like over here in the dot-com bubble, you can see we crossed it. I do think it'll look a lot like this. Cross it, but then come back. Okay, so the bulls are gaining, like the bulls have momentum in this situation. Obviously, divergence is good news for the bulls, and the bulls are gaining strength. And again, you don't see, once these two do not like each other, they are magnets with the same polarization. They're two positives. They do not attract. And I do think that these will diverge a lot sooner than later. Okay, and on top of that, again, this dark blue line right here, you can just see that we are currently on a very, very significant level of support. Every time we've seen this area tested in the past, aside from 08, 08 was the only time it was broken. And again, that's pretty much the entire financial system cracking. Right now, it's not in a good place, but it's not breaking. Okay, there's no underlying breakage. There's no, I mean, again, the bones are still good. The pillars are still standing. It's just we're sunburned, if we want to go with that weird analogy. Okay, anyway. So, again, a lot of support around this area right here, currently bouncing off that. Spent very little time here in the past, and I do think we will see, at the very least, a nice bounce back up to moderate levels prior to, hey, maybe we come down again. But, again, come down here, bounce significantly, come down again, bounce significantly. So just looking at this, we're due for a pretty significant bounce, okay? Everything is just so oversold. Not just if you look at the standard like RSI, Stoke RSI, just in the standard market environment, but a lot of indicators. Even if you look at the credit markets, which we're not going to do today because that's boring, you can go take a look at that on CNBC or Bloomberg or something, look at the credit markets if you want to know that part of it. But those are super boring to me. But I hear people who are smarter than me in this space talk about the credit markets, and even the credit markets are pointing to a period, once again, an extended period of relief for the markets. Again, bull market isn't back, but there could be some green in the cards for June. To close it out, primary point I want to make is that I believe the short term will see green as the bulls and bears find a comfortable medium, and following proper mean reversion will probably range trade for quite a while until the next earnings season or until the Fed makes any unexpected changes to their policy, which again seems pretty unlikely on the bear side. I feel like the most bearish scenarios are already priced in terms of Fed policy. But hey, if they decide to slow down, if something changes in terms of inflation, again, the market crashing definitely changes the inflationary dynamics because just rich people are losing money. So again, there could be curveballs thrown. I don't think it's likely. Again, you as a trader, as an investor, trader primarily, I guess, you do your best to use the data points available to you to make the most rational decision you can when it comes to weighing the odds in your favor. Again, 60-40, 70-30, 80-20. Right now, I'm probably feeling solid 75-25, leaning bullish. Again, there's always the possibility that the bears win. 25% is still a lot. That is still, if you play out some crazy scenarios in your head about like there's a 25% chance of you getting bitten by a shark, right? You're not going to take those chances. It's too much to be safe. But again, I'm a trader. I play this game. I love playing this game. And right now I'm feeling far more confident that relief is in the cards as opposed to 2 more downside. Okay, so on that note, I do remain very confident in the build out of the portfolio. If you guys are part of the Waves fam, the subscription group or the newsletter portfolio group, one of the OG subscribers, one of the real ones, let me know in the comments down below. Let me know if you're excited for the month of June ahead, and I'm excited to see what is in store for the home team for the Waves fam. Again, you guys go take advantage of the 7-day free trial. If you haven't given it a shot, if you've been thinking about it, go give it a shot. Go give her a go. I trust you will not be disappointed. But once again, I will let you be the judge of that. First link in the description box down below. I'll also see you in the comments down below as well. Talk some shop. Talk about whatever you want to talk about. And have a great Memorial Day weekend, you guys. Cheers. I'll talk to you next time. Until then, always remember, take action. Make waves. Peace.